Hello and welcome back to another episode of Majlis and Market. I am your host Hassan Javraj. In this podcast, we bring you thought-provoking conversations with influential leaders in Islamic and global markets. Wherever you're listening, remember to like, share and subscribe. Also get in touch with us by sending us an email at hassan@majlisandmarkets.com, and be sure to follow us on LinkedIn at Majlis and Markets. Today, we're looking at the GCC debt capital markets. According to Fitch, the GCC debt capital market has soared to nearly $1 trillion. In the first 5 months of 2024, emerging market dollar debt issuance, excluding China, topped $200 billion, with Saudi Arabia leading at 18.5% and the UAE at 9%. This growth highlights the GCC's rising role in global bond markets, but it also brings challenges like fluctuating US interest rates and oil price swings. To help us understand these developments, we're joined by Abdul Qadir Hussain, Head of Fixed Income Asset Management at Arqam Capital. With over 30 years of experience, he'll explain why the GCC is so attractive to bond investors and the key risks to watch out for. Abdul Qadir Hussain, welcome to Majlis and Markets. Great to have you here.
Thank you, Hassan. Lovely to be here.
Abdul Qadir, you're calling us, so we're talking to you from sunny California in Los Angeles, but today we're actually focusing on something that's close to you, which is the Middle East or emerging markets, debt capital markets. I think you're probably one of the more premier portfolio managers in the region. You've got a really illustrious career. But before we get into what you're doing today and your thoughts on the market, could you give us or give our listeners your background story?
Sure. I grew up in Pakistan, left after my A-levels and did my undergrad from the University of Pennsylvania, the Wharton School, and then did my master's from the Anderson School at UCLA. Worked for a few years out here in the U.S., down in Newport Beach for a company called Pacific Life, which was basically at that point the parent company of PIMCO. And then, I don't know kind of what got into me, but I decided that I would throw myself right into the middle of a storm, and I moved to Asia right in the middle of the Asian financial crisis in 1997, the Thai baht crisis. Landed in Singapore in September of 97 with under red hazy skies with the fires in Indonesia burning, covering the entire Singapore skyline. And basically was almost immediately thrown into an experience that I think pretty much formed my entire sort of outlook and career on emerging market and emerging market debt. Because while I was hired ostensibly to essentially run the credit research function at a firm called Peregrine, literally a week after landing, I was put on a team to try to restructure a distressed credit in Indonesia called SteadySafe, which was one of the large taxi companies in Indonesia, and that had borrowed in dollars. The rupiah had blown up. All the revenue was in rupiah, so they were basically having trouble repaying their debt, and it was a large prop exposure for Peregrine, and unfortunately one of the reasons that brought that company down in the end. And so, within a couple of weeks, I was out on the streets of Jakarta, trying to track down the owner of this company and trying to figure out and work out a restructuring plan. And, I just learned a lot about how emerging market owners can operate, learned a lot about how important it is to structure deals properly, to covenant them properly, learned a lot about jurisdiction, the fact that you have UK law or US law on a lot of these issues, on a lot of these bond and sukuk issues, only takes you so far, because at the end of the day, enforcement is always going to be under the home country jurisdiction. And that's a whole nother, can of worms. Unfortunately, Indonesia is probably more notorious than most other countries as far as that is concerned. Even till today, while they are an investment grade country, they still have issues like they did with Garuda, where they, at the Garuda sukuk, where they essentially crammed down an extremely unfavorable restructuring to creditors just because they could. So yeah, so that I was in Asia for about 6.5 years. Learned a lot through that time. Was also the lead distressed debt analyst on the largest corporate bankruptcy that in the emerging market space that happened at that time, which was a company called Asia Pulp and Paper, which had about $17 billion of debt outstanding in the capital markets across all parts of the capital structure: holding company, operating company, preferreds, the whole bit. And so that was another, a very meaningful and learning experience. And to be honest, that company and the research that I did on that company is actually really what launched my career, because that's kind of when I became known in sort of in the emerging market space as an Asian debt distressed debt expert. A lot of the large U.S. fund managers. I got exposure to a lot of the large U.S. fund managers, to a lot of the large special situation houses. Then I moved to London to basically head up Credit Suisse's corporate credit research for outside the U.S. And almost as soon as I did that, we had the Enron WorldCom issue, and then we had the Spitzer rules come out, which really essentially took a lot of the teeth out of credit research, or research rather in general, from investment banks. And as sort of the head of the department, I ended up spending more time with compliance and legal issues rather than doing any research. So I got a bit tired of that and kind of told my bosses, this is not really what I had signed up for. So they were kind enough to say, okay, well, why don't you put your money where your mouth is, and we'll give you a prop limit and start trading prop based on your recommendations and outlook. So in 2004, I started trading prop. Hadn't really been a trader before that. Had been pretty much just an analyst, and basically a fundamentals kind of guy. But started that in 2004. Did it for about 3 years. Family reasons, didn't really settle well in London. I know you're from there, so I don't want to say any negative things about that. But it was just not a great experience for the family. And so the opportunity with Mashreq in Dubai came literally completely coincidentally. We were there for a vacation, ran into a couple of guys from Mashreq. One thing led to another. Next thing I knew, there's an offer to establish a prop desk at Mashreq, doing the same thing I was doing at Credit Suisse. So moved to Dubai in April of 2006, and I've pretty much been there ever since. Started off doing purely prop for Mashreq Bank, but then they had a license in the DIFC for basically a Category 2 license, which essentially is something that allows you to do everything except take deposits. And so we decided, or the Mashreq decided, that they wanted to launch an asset management business through that DIFC entity. So that's what I did. I set up their asset management business in 2006. We launched the first dollar-denominated sukuk fund in 2009. It was at that time, it was called the Badr al-Islami Income Fund. Now it's called the Mashreq al-Islami Income Fund. And then in 2016, I moved from Mashreq to Arqam, and did the same thing, set up the fixed income asset management business for Arqam. And alhamdulillah, now we've got a bit under $1 billion under management. Started off from zero in 2016, and it's particularly pleasing to me because the business is all sort of grown organically. There was no seed capital. There was no captive AUM like there was at Mashriq. There was a lot of captive AUM from the family, from the bank itself. But at Arham, it's basically all third-party AUM, and I think it's basically the track record, our processes, and the team that has resulted in this growth. So, very happy about that.
Fantastic. It sounds like you've had like quite a career so far. You started off in the US and then you moved to like Asia and then London, and now you're in the Middle East. You saw the Asian financial crisis, you saw Enron, like you mentioned. So you're quite used to seeing like stuff blow up. Well, like financial stuff blow up, right? From what you're saying.
Yeah. Yeah, I mean, I think I've sort of been through it all. I mean, when I started my career at Pacific Life, pretty much the first couple of months that I walked in was the Mexican peso crisis. They called it the tequila crisis. So right from '94, actually, to be honest, right from 1987. I was just an analyst at GE Capital after my undergrad. I had taken a job at GE Capital, and we had the October crash, the October 1987 crash, which now 500 points on the Dow doesn't look like a big deal, but at that time, the world had sort of crumbled. So yeah, right from that point up until COVID, the interest rate, the bear market interest rate sell-off of 2022, been through it all. That's why I don't have any hair anymore, and whatever is left is all gray. So.
Abdul Qadir, we had Sharif Eid on a couple episodes, well, early on in the season, and he gave us a nice rundown of the capital markets. But before we get into like your thoughts on the MENA DCM or debt capital markets, what does your typical day look like as a portfolio manager? Look like? Is it like similar to Sharif, where you're like looking at spreadsheets and looking at Bloomberg terminals and reading articles?
Well, I mean, I think, from my perspective, the primary role of a portfolio manager really is risk management. So I'm focused very much on making sure that our portfolios reflect our views in an accurate manner, reflect the risk appetite that we want to carry in the portfolios in an accurate manner. So, I spend a lot of time making sure that, for example, we're positioned correctly in terms of our overall, credit ratings in the portfolio, the risk ratings. We're positioned correctly in terms of our overall duration and interest rate exposure. We have the right exposure in the right buckets, which is reflective of our views. We have a very good team in terms of sort of picking which sukuk or which bond to buy, what is the underlying strengths and weaknesses and valuations. We have a very robust process and a good team to do that. So I think we always have a ready sort of inventory and list of recommendations of individual securities that we want to put into the portfolio. So, that takes a percentage of the time, but it doesn't take, for me at sort of more the portfolio management level and the macro level, it doesn't use up the majority of my time. The majority of my time, like I said, is making sure that the portfolio is constructed properly. And then obviously, being sort of in charge of the business, there's also a lot of time spent with clients, making pitches for new mandates, and dealing with a lot of the sort of internal admin stuff. But that's pretty much what a typical day looks like. You walk in, you make sure that your risk is where you want it to be based on your information. You know, you have some client interaction, you look at some individual credits, you look at what's happening in the markets, you read some research, and yeah, that's pretty much it.
Fantastic. Abdul Qadir, when we look at the Middle East capital markets, you've been there since I think you said 2006, so it's nearly been 20 years coming up. And like for me, like having covering the market since 2013, it's been like incredible to see like the development, especially in the last like say 6 or 7 years of the MENA debt capital markets, both conventional and Islamic. But like when we look at it today, Abdul Qadir, the Middle East seems like a very active uh, part of the emerging markets. Why do you think investors like the Middle East, and why do you think it's an important part of emerging markets?
Well, I think there are several reasons. I mean, you're right. You know, when I landed in Dubai in 2006, literally, you had probably, you could probably have 20 or 25 issues in the entire market. Most of them were 5-year senior bank paper. I think the only sukuk was a company called PCFC, which was actually the predecessor to DP World, and that was a convertible sukuk. And from there, you sort of saw a steady growth. Um, but to be honest, it was snail's pace till 2014, and you had the oil price crash in 2014, and you had Saudi enter the market. In 2014, total bond issuance out of Saudi, and none of it was sovereign. It was all sort of banks and some corporates and so on, was under $20 billion. Today, it is over $200 billion. It is Saudi is the second largest constituent of the emerging market bond index after Mexico, and the rate at which it's issuing, it's probably going to become the largest in the next 12 months, I would say. So I think first and foremost has been supply, right? It just there's been the market has just blown up. You've got almost $600 billion of issuance from the region. If you include Turkey, Turkey doesn't. I'm not including Turkey in the 600 billion, but if you include Turkey in as a percentage, you're close to 20% of the emerging market bond index. You're whether it's corporate, whether it's just sovereigns, whether it's GREs, across all facets, you're now a major part of the emerging market bond index. So investors can't ignore it just because it's now just become too big. So that's one aspect of it. The second aspect of it is that it is one of the few emerging market plays that has stable pegged currencies. So essentially, there is no differentiation between local currency and dollar investing in the GCC market. So, unlike, places like Egypt and Turkey and Indonesia and Brazil and, a lot of the other traditional emerging markets where, local currency markets are a completely separate asset class because of the currency volatility and the floating currency regimes. That's not what you have here. And so, for a lot of the emerging market bond investor space, this represents not only a large part of the index, but it represents essentially a play that doesn't really, expose you to a significant amount of underlying currency volatility. So that's, I think, the second reason why it's sort of increased in interest for global guys. And then the third and final reason, I think, has to do with the rest of the market. So Russia has become uninvestable. Obviously, China has pretty much dropped off most investors' radar screens. So, by default, this has become, a bigger market with more focus. And then finally, it's also, once you use, particularly if you take, China, which typically was a very tight, investment grade type market before the real estate crisis blew that up. this is one of the more low volatility parts of the EM space where global guys can essentially hide when they feel the risks are rising across the emerging market space. So I think for all those reasons, it's now become a main play. It's interesting because you're starting to see some of the same trends that I saw in Asia during the Asian crisis and following the Asian crisis when the Asian bond markets started sort of recovering and growing back up from the Asian crisis, and that you started getting a lot more locally based managers. You started getting a lot of locally based allocators. So you've now reached a deal in Asia. We haven't gotten there yet in MENA, but you've now reached a stage in Asia where you can price an Asian bond outside of New York time. You don't need you don't even need the US to come in. Sometimes you don't even need London to come in. You can pretty much place the entire the entire paper within the Asian time zone. We're starting to get to that. We're getting more and more asset managers move into the region. We're also starting to get more and more allocators from the region allocating to a dedicated GCC / MENA strategies. So I think that's these are all sort of positive trends, and seeing the market move in the right direction, and definitely a big step up from where we were when I started all this in 2006.
Definitely. I think like if you look at it in context, like as you said, right, over the last decade, I think they've done a lot of things. Like countries like Saudi now are like major bond investors and sukuk investors. And they have a lot of these big economic visions that they need to do as part of their economic diversification. And I guess one of the ways to draw outside capital is to issue debt, right?
Yep, yep, that's true. It is. I mean, I think that this is it's an interesting story because these are, for the most part, particularly in the GCC, other than maybe Bahrain and Oman to some extent, these are very high credit quality countries. They obviously have huge amount of natural resource based revenues. They are these are typically not your typical profile of emerging market issuers where you've got deficit financing going on, you've got current account deficits, you've got a lot of volatility in your currency, and there are a lot of sort of unique aspects to all of this. But you've also got to keep in mind that along with that, you've got credit trends in general that are, for the most part, negative to some extent, because particularly Saudi, for example, is levering up its economy. Like I said, it had less than 20 billion of issuance. Now it's got 200 billion of issuance. It's got it's got a extensive local currency debt market, and so while it's still obviously a strong single A rated country, and probably I think would have been a candidate even potentially for an upgrade earlier this year, but I think they've clearly indicated that they're going to issue more debt than they had indicated at the start of the year. So I don't think rating agencies are going to move on that front anymore. But these countries are taking on a lot of debt, and there is a fair amount of execution risk in making sure that the projects and the things that the debt is going to be used for are successful, are cash generative, and will allow the country to eventually delever and pay down that debt. Dubai is a great example of that successfully happening, even though we got very, very close, obviously, in 2009 to disaster. But they survived that with the help of some friends, and now they're in a situation where they've significantly delevered. It's a lot of the projects that the money was spent on, whether it was SALIC, whether it was RTA, whether it was a lot of the infrastructure spending. Um, a lot of that has borne fruit and resulted in cash flows that have allowed the and IPOs and privatizations and so on that have allowed the emirate to significantly reduce its debt stack. So one is hopeful that that sort of model is going to be repeated across, particularly in Saudi, which is taking on a lot of the debt right now to sort of diversify its economy away from oil.
What about the less known GCC names? So we've got obviously Saudi, which is very prominent in the DCM market, in UAE, so by extension Dubai, Abu Dhabi, Sharjah. But what about the likes of, say, Qatar or Kuwait or Bahrain? I know in Kuwait it's quite a contentious issue, the public debt law. And obviously now with the political situation in Kuwait, it's making things a little bit could make things a little bit complicated. But like the lesser known names, do you think they also give like good value in the DCM market?
Yeah, so I think Oman has been an interesting example. I mean, it's a couple of years ago, it really looked like it was headed in the wrong direction, and there really wasn't a lot of positive light. But one, obviously, oil prices recovered post COVID, and that helped them significantly. Prices getting back above 60, 70 into the 80s helped them. And then, to be honest, they did do some of the things that they wanted to do, including sort of VAT and certain subsidy reform and things like that, which brought the debt situation under control, and really was an example of how you can sort of turn around a negative credit trend, albeit with obviously certain favorable market conditions behind your back. But has been a great story for credit investors. Omani paper was trading double-digit yields a couple of years ago, and now it's pretty much back to investment grade. And there is a good, even though it's not officially rated investment grade, I think there's a good likelihood that it gets there relatively soon. Bahrain, continues to sort of be the GCC/Saudi proxy. It's a difficult economy, right? It's a very small economy. It's particularly now with all the changes going on in Saudi. One of the legs that it stood on, which was Saudi tourism, that's sort of become less of an impact. Oil and gas, are still the main drivers. It's difficult given the scale, it's difficult for other, industries to really thrive and grow over there. So it's likely to sort of remain the way it is. It's obviously in the overall context of things, it's relatively small, and therefore GCC support, should continue because it's really not a major exposure for particularly Saudi and the UAE, and the cost of something bad happening in Bahrain and how that would impact the entire region is probably bigger than the cost of making sure that they have the support that they need. Kuwait, like you said, I think it's a bit of a political issue. There are very small players in the market, very few other than the banks and some of the bank perpetuals, which can be very good value. There's really not a lot of issuance, and I think people, just kind of are less interested because of all the political turmoil that it goes through every few years. Um, but I think that in terms of valuations, all of these are if you look at it from a historical standpoint, most of these countries, including Saudi and UAE and all, are trading at the tighter end of where spreads are. And so from a credit spread valuation standpoint, they generally tend to be tight. But the interesting thing there, particularly from a global EM allocator's point of view, is that most global EM guys tend to compare this region versus Asia and Asian high grade and investment grade paper. And so, and their sort of relative value comparisons are based on, Saudi versus Korea or Malaysia or Thailand or, those places. And in that context, the region has still continues to offer a bit of value, which is why, given the extensive new issuance that you've had this year, the issuance has been absorbed relatively stably, right? Because it hasn't resulted. I know we haven't talked new issue numbers, but we're well over 100 billion in total issuance, and we're only sitting in July. And last year we only had like 75 billion of issuance, and the peak of issuance I think was in 2020 when we had like 120 billion or 118 billion. We're going to cross well north of 150 this year. So this is going to be the largest issuance year in the region, and it hasn't resulted in a huge dislocation of spreads, even though spreads are generally tight. And one of the reasons is because on a relative basis versus Asia, it still offers a bit of a pickup. And that means that not only global EM investors in the U.S. and London, but also the Asian guys will continue to allocate because they're getting a bit of a pickup here. So in general, spreads are tight, but from unless you get a significant global recession or obviously geopolitical volatility that's more than what we're getting now, even though I don't know how we can do that. But unless you get that sort of shock, I don't see spreads widening meaningfully, into the year end. We are starting to see obviously equity markets crack in the U.S. and that could if that sort of bleeds into an overall risk market sell-off, then you could see some spread widening. But I think that would be potentially compensated by rates coming down to some extent. So that the effect on returns in the market would be muted. So yeah, I mean, I think the overall valuations are tight, but on a relative basis, they still look fairly decent.
As we bring the podcast to a close shortly, Abdul Qadir, there's two areas I wanted to ask you about. The first, I know you're quite active on social media and you've talked about this previously, and other portfolio managers as well in the region have mentioned this to me over the years, is the sukuk market and AOIFI standards on sukuk issuances, particularly out of the UAE. The UAE Central Bank's Higher Sharia Authority, which was set up, I think, in 2018 and became active more in 2019, 2020, really had an impact on sukuk issuances out of the UAE, or sukuk issuances as well, being targeted to UAE investors. From your perspective, what are your thoughts on the sukuk market and all these AOIFI standards coming in to the issuances?
Yeah, I think that's a very interesting question, and I think that it is to be honest, an existential question for the sukuk market because the underlying problem is that I think the market, and I'm not a Sharia scholar, I'm not an Islamic finance sort of structuring expert. I'm an investor and have been for a long time. But I feel like the market kind of got away from what the experts and the scholars envisaged when they first launched this market. They launched the market with the intention of sort of having an Islamic alternative to traditional riba based or interest based bonds. But they did it, and then I think they did it basically because they said it was necessary at that point to have the market grow. They did it essentially by mimicking as closely as they could the traditional bond, conventional bond structures. Interest payments, default provisions, not interest payments, sorry, profit payments based on interest rates, default provisions, the structures, they all very much mimicked, traditional bonds. And then, AOFI came in, you had Sheikh Taqi Usmani from Pakistan come in a few years ago and, said, the conventional commodity murabaha and other kind of things are, we've got to go beyond the, it's necessity is no longer an excuse. The market is big enough. We need to sort of right the ship and take it towards more traditional Islamic finance, which is essentially risk sharing, right? And that is that completely flies in the face of traditional conventional fixed income. Traditional conventional fixed income is not risk sharing. It's basically I owe you money, you pay me back, regardless of however you do. And so this is an existential question. I mean, at the end of the day, the only sort of really marketable fixed income structure and the one that's going to be least problematic is the ijara structure, right? Because that's essentially a sale leaseback. It's a very easy structure to understand. It's easy from an Islamic finance point of view. Rental income, lease income are very, very traditional Islamic fixed income type flows. So I think that the market has to decide. I mean, I think we are at a point where investors in the market have to decide that are we going to be traditional type conventional players, or are we going to actually try to take this market more into the proper Islamic space, which is going to be a more of a risk sharing model. So until that happens, we are going to get situations like we do, which is like you said, certain issues come out from other countries that UAE banks are not allowed to participate in. That UAE banks cannot be on the underwriting teams of, and then other issues are fine, and then therefore you get a kind of a dual liquidity scenario, because some issues become more liquid than others because they have a wider acceptance because of their AOFI compliance. But to me, that's not a sustainable solution. The market's going to have to decide at one point or the other, whether we are going to stick with AOFI compliance, or we're going to just go back to the old sukuk way and just continue doing it that way.
I mean, do you have a view of how it should go? Do you think like they should be more risk sharing, profit loss sharing, or do you think they should try and stick to more like sort of fixed income instrument?
That's I mean, I think, as from a Islamic perspective, I don't think there's any doubt that you need to get into more of a risk sharing type structure. But what I'm saying is that then it no longer becomes the market that it is, right? It essentially is investors can no longer treat it as a proxy for the bond market. Issuers can no longer treat it as a proxy for fixed income issuance. It becomes a completely different animal, and I think that there is. It's not going to get there overnight. I think there has to be a gradual move towards that. But I think that is if the true spirit is to create a true Sharia financing and Islamic financing model, then you have to get into that risk sharing space, because other than that, it's not it's really not doing what it's supposed to be doing.
My other question, Abdul Qadir, in the interest of your time, is the risks for general fixed income going into 2025. What do you think are the top risks that people should be thinking about going into next year?
Well, I think it's interesting because we are now at an inflection point in rates, right? Because people are now saying September, the market is essentially saying September cut is 100% probability, and my view is there's never anything that's 100% in markets, and when you get into a situation where markets start pricing in that kind of certainty, it means that the chances of disappointment and volatility around that disappointment increase. And I think the biggest risk to me is essentially U.S. elections. I think in the next 4 or 5 months, we're going to see increased volatility across all financial markets based on what's how the elections are going to play out. I think to some extent both sides are going to continue inflationary policies, but obviously the Republicans and the Trump policies from a headline perspective sound quite problematic as far as trying to contain inflation. When you're talking about reducing taxes, increasing tariffs, deporting people, putting up trade barriers, all of these kind of things. These things are all, will all potentially, stoke inflation. So to me, the biggest risk, particularly on the fixed income side, is we get sanguine about rates coming down and sort of moving in one direction, and then you get a shock like you did in the early '80s during the Volcker time, where suddenly the Fed has to come back and sort of react and go the other way. I think that it certainly doesn't seem like that's going to happen. It certainly seems like the U.S. is slowing down and inflation is going to come down. But I think that the political volatility could cause some unpleasant sort of things to happen in the markets, and that's kind of what we're watching out for the next 6 months or so.
And just very briefly on the Middle East fixed income, you're not concerned about oil prices or geopolitical situations impacting the market there?
Well, I mean, we lived through the the Iranian drone attack on Israel without a major impact on spreads. So I mean, I think if we could survive that, we should be able to survive most situations. Obviously, I think if it gets into some sort of extended conflict across the region, that's going to change everything drastically. But it doesn't. To right now, that doesn't seem to be a major issue. I think oil prices, clearly, if you get a significant slowdown in global growth and prices come down, below sort of 70 into the low 60s, you will definitely see spread widening in the region. But I think that is something that's potentially a 2025 type situation. And if you do see that, a lot of that will be compensated by declining rates. So the net impact, hopefully shouldn't be too drastic, particularly on the investment grade side in the region.
Abdul Qadir, tell us any projects you're working on or any upcoming things that people should know about.
Well, I think obviously from a firm perspective, our big thing now is we're about to get licensed to manage assets in Saudi, so that's going to be a big thing to be onshore in Saudi. I think from a longer term personal perspective, I'm trying to get something, or I'm trying to look at potentially, in the longer term, once I sort of move on towards retirement, I definitely feel that there is a need for Islamic-based or Sharia-based financial advisory in the U.S. and in Western markets. I think we have products in these markets that are targeted towards Sharia investors, but we don't have a lot of proper financial planners and advisors in the markets that cater to this particular segment. So I think that's, I am, potentially working on some solutions towards that in the longer run.
Fantastic. And I mentioned you're quite active on social media. So what's the best what's the best way to get hold of you on social media? Do you have like a LinkedIn or
Yeah.
Twitter?
Yeah, I think LinkedIn is really the only active social media I have, and happy to entertain contacts via LinkedIn.
Fantastic. Abdul Qadir Hussain, I wish you all the best and thanks again for coming on the podcast.
Thank you. Thank you for having me.